I read the book, The Warren Buffett Way, by Robert G. Hagstrom. As book reading is a good habit, but quick book understanding is a need of time, and so summarize the book in this short video. This book explains investment philosophy and principles of Warren Buffett, and distills Buffett's approach into a clear, practical framework for long-term investing. Core philosophy centers around value investing, a concept he learned from his mentor Benjamin Graham. The idea is to buy stocks of companies that are undervalued compared to their intrinsic worth, and hold them for the long term. If we take core philosophy as base, then next comes is selection of stock. The first criteria is business. Buffett evaluates businesses based on understanding of business. He only invests in businesses he fully understands. Then, consistent operating history. The company should have stable and predictable earnings. Third is favorable long-term prospects, where he looks for sustainable competitive advantages, which he also calls economic moats. Okay, so after understanding business, query comes for trust. There comes management in the picture. Management should be honest and candid leadership. They should be rational in allocating of capital, and should be able to create shareholder value. Now it's a money game, so financial tenets are important to verify management's activities. There are some financial indicators, like high return on equity, ROE, consistent profit margins, low debt relative to equity, and strong cash flows. Today we see influencing in finance, but it is as old as business. However, Buffett ignores market trends and focuses on facts. Buffett buys at a significant discount to intrinsic value, which is also called margin of safety. He treats stock purchases as buying a piece of a business, not just trading pieces of paper. As facts matters most, and so discipline, which needs to be strengthened by psychology. Patience and emotional control is necessary, and avoid following the crowd. Do not react to market noise or short-term volatility, and focus on long-term compounding. In short, the Warren Buffett way is not a get-rich-quick method, but a guide to disciplined, thoughtful, long-term investing focused on high-quality businesses purchased at fair prices. Let's also see some key takeaways from this book is invest in businesses you understand. It means stick to your circle of competence. Only invest in companies whose business models, products, and markets you can clearly grasp. Second, look for durable competitive advantages. In Buffett's words, economic moats, which means favor companies with sustainable advantages like brand strength, cost leadership, network effects, etc. Third is focus on management quality, which means invest in companies with honest, capable, and shareholder-friendly management teams. Fourth, financial strength is crucial means. Look for companies with strong balance sheets, high return on equity, consistent profit margins, and strong free cash flows. Fifth is margin of safety, which belongs to core principle. It means always buy at a price well below the estimated intrinsic value to allow a cushion against errors or unforeseen events. Sixth is patience, which always will pay, and so time is the friend of great businesses. Hold investments long-term to allow compounding to work. Seventh, ignore market noise. Don't follow others but self-study. Do not get influenced by market fluctuations or popular opinion. Focus on business fundamentals, not stock prices. 8. Concentrated portfolio. Buffett believes in owning fewer, carefully chosen stocks rather than over-diversifying. 9th, independent thinking and have confidence, and so be willing to go against the crowd when your analysis justifies it. 10th, discipline and emotional control, which means avoid fear and greed. Maintain discipline through market ups and downs. Thanks for watching.